Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Guy Johnson and Tom Mackenzie. With the cash trade just less than an hour away, here's what you need to know. Global stocks rally with the S&P 500 hitting a record high as cooler US inflation reinforces bets on Fed rate cuts. Slovakia's Prime Minister is still in hospital after an attempted assassination in broad daylight. The shooting of Robert Fico brutally exposing the widening political divide in the EU nation. Plus, Russian leader Vladimir Putin is given the red carpet treatment in Beijing as he looks to Chinese President Xi Jinping for backing in his war against Ukraine.
Let's check in on the markets then. Risk on across these markets, helped, of course, by weaker retail sales and a softer inflation print out of the US, and a lot of moves coming through across the Treasury market yesterday. European futures pointing to gains of just shy of 0.2%. You did have the S&P, of course, crossing above 5,300 by the close of the session yesterday. FTSE 100 looking to add 23 points, up 0.3%. We watch iron ore and copper prices are elevated again. 431 on the US 10-year after yields dropped 10 basis points yesterday. Euro dollar at 108. Markets today starts right now.
Thursday the 16th of May. Good morning, everybody. Goldilocks is back. Risk is on. I suspect it probably has more to do with what we saw yesterday in the retail sales data rather than the CPI print. The CPI print in many ways still looks sticky, particularly if you take a look at the Supercore print, which certainly still looks sticky. It probably feels like the Fed is going to look at this data and say we've got more work to do here. But the retail sales number was just right. Not too hot, not too cold. Just beginning to roll off a little bit, just what the market wanted to hear. I would, however, caveat it. Walmart is about to post numbers. It will do so later today. The call is at 8 a.m. Eastern time. I suspect that a lot of people are going to want to tune in to that call to get an idea of how the US consumer is really behaving. The data telling us one thing. Are the corporates going to be telling us something else? Walmart will be a useful barometer to tell us what's really happening with the US economy. But basically, the market took this data yesterday in aggregate as just right, not too hot, not too cold. Thank you very much.
Yes, Goldilocks is back in the building. If she ever left, she's very much pulled up one of those chairs and present. I was reading Edward Harrison on the Markets Live blog talking about the definition of Goldilocks and talking about how this really means you get rate cuts, but you also manage to avoid recession. And if the Fed manages to pull off that trick, that would be quite an achievement.
That if is still yes. Consequential, isn't it? So the narrative seems to have moved from if the Fed cuts to when again. We've kind of swung back to that with the markets pricing in too. But there is a little bit of hint of scepticism from some out there. I mean, most of it is very positive, obviously. But the question of whether or not the markets are overlooking the chance, the risk, to your point, of a downturn in this economy. Given what we've seen in the jobs data, given what we've seen in those retail sales, you called it Goldilocks in terms of the perfect mix in terms of retail sales. But again, if you get Walmart coming out later suggesting that the consumer's really feeling the pinch, is this a market that's once again primed to look for the upside and overlooking the downturn risks?
It does certainly feel that way, doesn't it? We feel like I feel like I've watched the Goldilocks movie 2 or 3 times this year. She keeps coming back to Anna's point. She just kind of walks around the building, comes back in again, tests the porridge, just right. Thank you very much. We'll move on. But it does seem as if the market continues to be on the side of we are going to see a soft landing. It is going to be just right. Now, just right was 7 rate cuts at the beginning of the year. Just right is now 2 rate cuts. Can somebody make up their mind here, please?
Yeah, absolutely. We've gone from 6, 7 at the beginning of the year to hardly any, to your point, Tom. Then we ruled that out yesterday, it seems, and we will be back to cuts. So that does seem to be the current expectation. It's interesting to think of the things, if we think about Goldilocks and her stool and the legs of the stool and what's propping it up right now, we've got the consumer story and whether it is just right. Then there's the earnings story as well. And we've got Nvidia next week, and I wonder if that is going to be something obviously important and to watch. But that's another threat to this all-time highs on stocks narrative that we're talking about this morning.
Because the expectations are so high, aren't they? I mean, we've seen the latest details around the hedge funds and their positioning around Nvidia, and I think we're going to unpack that story in more detail. But clearly, from the hedge funds' perspective, that capital continues to see a positive story when it comes to Nvidia. But that is a risk, isn't it, if Nvidia doesn't perform to the expectations? But we have more on the earnings story from the European front now, in the airlines front.
Johan Lundgren is going to be stepping down.
Yeah, absolutely. So there are earnings, but then there's also that red headline. Yes, exactly. The CEO, Johan Lundgren, stepping down in early 2025, so giving us a bit of notice of that. I think he's been there since 2017, so a decent length tenure for Johan Lundgren. We're going to be speaking to him later in the programme. And interesting, he's before he joined EasyJet, he had a sort of package holiday background at TUI, and I wanted to get his take on the way that the low-cost airline sector, or at least parts of it, seem to be doing a sort of volte-face and going full circle on that one and going back to packaging things up in a time when consumers are conscious about costs.
We unpacked our TV. Now we're repackaging that. Yeah. It seems every time I look at a Sky advert at the moment, it seems we're packaging Netflix and this and that and everything else back into one place. So we seem to be certainly going back in that direction. The 1970s were the big era of the package holiday. I do remember. That's when they really took off.
You remember?
Maybe we're back to that. No, I've been reading a lot about the 1970s and the economy.
Flashbacks to your Benidorm holidays
exactly.
in the 1970s.
And you do wonder whether kind of that era seems to be kind of poking its nose back into the present day at the moment. Stagflation risks, package holidays are back, all these kinds of things are coming back to the fore. Yeah, so Johan is going to be stepping down. Michael O'Leary the other day was talking, though, about the summer being softer than maybe he anticipated on fares. Now, Johan's in a really invidious sort of place at the moment, in as much as he's got Airbus aircraft, A320s, so no problem with the MAX that Michael's facing. Plus, he doesn't have the Pratt & Whitney engine problem that Wizz is facing.
Happy days.
So he's got CFM engines, which is the kind of the only engine that at the moment is kind of delivering. So he, in some ways, is doing quite well. Yeah. Which I think
does that mean there's a real chance that they can get market share then?
In theory, yeah, but they've got to have the aircraft to be able to put onto the routes, and it's going to be interesting to see whether or not he we'll talk to him about this later. Yeah. But whether or not he does have that kind of ability to maybe put some extra capacity on and maybe generate a little higher performance as a result of that. Let's talk about another company that is out with numbers this morning. We've got Zurich Insurance out with its figures. The company, which remember is in P&C, it does life insurance. It is basically saying that revenue is higher. It rose in property and casualty up by 12% in the first quarter. That's on a like-for-like basis and has been driven basically by higher premiums. Now, we're all, I suspect, maybe more in the car sector than in this sector, looking at higher premiums, and that is a key driver of inflation right now. Mario Greco, the group's CEO, joins us now from Zurich. Mario, great to see you. Thank you very much indeed for joining us this morning. So first quarter non-life revenue rising, higher premiums are the big driver of that. How much pricing power do you have right now, and how sustainable is that pricing power?
In the retail sector, pricing power is pretty strong at the moment. Retail is still recuperating from insufficient profits over the past 2 years. So we're very confident that retail will continue on the same trend, and it might even accelerate later on in the year. On the commercial side, the property is still the highest rate growth line, and will remain so. And the casualty remains in the high single-digit numbers for the rest of the year. So we're quite confident that the rate situation is stable or positive for us through the end of the year.
So this is going to continue. So the guidance is that basically this picture is going to persist throughout the rest of the year. Mario, we've got a story here at Bloomberg out today on the Bloomberg terminal talking about the fact that we are seeing increasing rate volatility in the bond market. You've had to move to IFRS, if I can get that out, 17, which to my mind makes you a little bit more vulnerable. Makes you a little bit more vulnerable to volatility in the bond market. Is that making guidance more difficult? Is the bond market volatility making it harder for you to deliver clear guidance right now?
I mean, overall, the trend in the bond market is definitely positive for us compared with a couple of years ago. So, yes, there is short-term volatility these days, but this doesn't have a strong impact on our results. The most important thing is that the rates are significantly higher than they were some years ago, and this is a great tailwind for our business and for our industry.
So the rate story is positive for you, Mario. Good morning. As we look ahead, perhaps to some rate cuts. Some years ago, or some months ago, you were trying to sell parts of your business, $20 billion worth of your life insurance book to Viridium. That didn't work out, but that was to make the business, or one strategy to make the business less affected by rate volatility. Do you see less urgency to do that now?
Good morning, Anna. Actually, the decision to try to sell the business wasn't based on any rate position. That was a risk prevention measure, because that business, in case of a shock in the financial markets, will give us some capital stress. And so we decided, irrespective of the rate conditions, to go into the market and sell that business. For different reasons, that did not work out well. So now we pause, we reanalyze the situation. There are more options available for us today. And likely next year, we will announce which solution we want to take for this business.
OK, so we watch to see what happens with that business. One of the issues around selling it had been when it was going into the hands of private equity, Mario, and it seems regulators unsure about life assets in PE hands. What's your thinking on the risks that would pose, given that perhaps some would say, you know, that the life insurance sector obviously has to have a very long-term perspective?
We were selling to a life company, which happened to be then owned at the time, now is in a process of a transaction, but at the time happened to be owned by private equity. So we were not selling to a private equity. We were selling to a life company. I do see the risks, and I'm aware that in some European markets there have been episodes of private equities not holding on their commitments and their duties. And so we will be aware of this for any future move we will take in the markets.
Mario, good morning. You've got a history of returning cash to shareholders, funding buybacks. Is there more you can do on that front as you look at the quarters ahead?
We're about to start a buyback that we announced last November and that the AGM has confirmed. This is a buyback for 1.1 billion Swiss francs, 1.3 billion roughly US dollars, and we're about to start it now. So we'll execute this buyback, and then we'll pause and see what's next for us and in which ways we can continue to return value to our shareholders.
It sounds like you think there might be scope to do more, Mario.
Every manager always has the ambition to be able to do more, of course.
OK. Give us a bit. You've talked a little bit about the M&A strategy. Flesh that out for us on back of these results. As you look forward, how does that M&A strategy refine itself? What are your priorities?
We'll continue with our priorities where we invest in businesses where we've already been successful. We look for local synergies, and we want to buy on strengths. And that's the way we've been acting in the past years in the M&A market, and we will continue with that. But our strategy is not M&A focused. We think we have a great franchise with excellent opportunities for growth just by continuing to work with our customers and improving the loyalty of our customers and develop from there to new customers. And we go to M&A if we find opportunities to enhance our returns where we have already strong businesses.
OK. Mario Greco, Group CEO of Zurich Insurance. Thank you very much indeed. From the earnings story to the geopolitics, and of course we have a state visit by Vladimir Putin to China, to Beijing. He's currently with the Chinese President Xi Jinping, it looks like, inside the Great Hall of the People, where they appear to be signing documents. They've reiterated their determination to deepen that relationship, of course, at a time when Europe and the US in particular are concerned about the depth of that relationship, particularly when it comes to China's support for Russia as it pursues, of course, its military aims and ambitions and that invasion in Ukraine. And we know that pressure has come through from recent visits as well from US officials.
Absolutely. We know plenty of Americans have been on the ground in China of late, and they've been putting pressure on China to change its stance towards Russia. And then we saw Xi Jinping in Europe just last week, and he was facing similar calls from the French president and beyond to change his stance with regards to Russia. We'll see whether, after poring over the detail of what has been signed and what is then said, whether there is any sign of change. But Guy, you know, on previous encounters between these two, we heard reference to no limits, and you wonder whether, just like the old cliche of the special relationship in the transatlantic context, you wonder whether this is the kind of thing that needs reiterating and saying again and again for people to believe it's still in place. And
how special is that relationship, and does it ebb and flow? I suspect it probably does to a certain extent, which is, I think, what you're hinting at. Look, this morning is a morning in some ways of political risk. You think about what is happening here. You look at the pictures on the screen right now. That represents maybe a hardening of Cold War II. This is the kind of narrative that maybe we are looking at here, developing out of this. Anna, in the headlines this morning, you mentioned what is happening in Slovakia, Fico, the shooting there, the Prime Minister fighting for his life this morning. You've got the Wilders government potentially beginning to take shape. Who will be Prime Minister in the Netherlands next? Who knows? But it looks like we're going to see a significant move to the right as a result of that. You've got Trump-Biden. We've now got confirmation of what is happening with the debates. That story is heating up as well. The political risk story around kind of these markets looks like it's becoming more and more interesting and increasingly kind of feeding through into the market narrative in a clearer and more defined way.
And how the partnership between these two countries, Russia and China, is tearing at the tensions, and you're seeing that, as you say, within Slovakia and elsewhere, the tensions in Europe being pressured by this close alliance. The trade story between these two countries is enormous, really significant, of course, in terms of the energy that China's taking in, and then things like car sales, Chinese car sales, electronics into the Russian market. They've met them more than 40 times now, these two leaders. But let's not make any mistake. Russia is the minnow player in this. They're heavily reliant, of course, on China in this relationship.
Yes, and to your point about the way that investors are having to factor in this geopolitics, we have at the same time a story about Michael Burry, Big Short fame. Despite all the geopolitical tensions, you know, he's increasing exposure to certain Chinese tech names. We've had various investors coming through saying China has just become so cheap that a couple of names in the last few weeks loading up on Chinese stocks. We will monitor how the geopolitics plays out and how it affects market thinking. Coming up, we're going to be hearing from JPMorgan Chase Chief Economist Bruce Kasman. That's live from the banks, that's JPMorgan's Global Markets Conference. It takes place in Paris. Francine Lacroix on the ground. We'll be hearing from that interview, that conversation, later on this programme. The US Bank's CEO, Jamie Dimon, will be also in conversation with Bloomberg. Don't miss that at 1:15 p.m. London time. Up next, global stocks soar after the latest US CPI print. We'll discuss the rally. If you have any questions for our guests, if you want to get involved in our conversations, please do get in touch. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
How much downward pressure is monetary policy putting on the economy? That's an unknown. We don't know for sure. And that tells me we probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
OK, Minneapolis Fed President Neil Kashkari wants to wait a little longer, questioning how much the central bank is restraining the US economy. He doesn't want to jump to premature conclusions. Joining us now is our Markets Live executive editor, Mark Cudmore. Let's talk about the markets in 2 minutes then, Mark. And let's start with the data of yesterday, the CPI, retail sales. This time yesterday, you thought that maybe retail sales might linger a little longer in our thinking. In the end, what did you make of the data set yesterday?
I don't know whether it's been a massive game changer. It's kind of kept us in that Goldilocks place that we've been for a while. I think the equities market rally can continue. I actually think that Kashkari's comments there were kind of spot on in terms of that we are seeing signs that consumers are starting to roll over. We're seeing signs that monetary policy is starting to crimp on the economy. We don't have enough evidence yet that's going to bring inflation down. That backdrop of kind of holding and waiting for now is good for stocks. And I do think that it's going to be hard for yields to go any higher. It's going to be hard for the dollar to go any higher because it's going to be, with that capping of yields and that re-leveraging into global stocks, it's an outflow out of the dollar. So I think they're the main backdrop themes, and I don't think they're changing because of the data yesterday.
OK, so it seems a bit Goldilocks. Certainly some voices on your Markets Live blog describing it as such, Mark. In terms of the surprises we've had here, the City Surprise Index now down in negative territory, but also on your blog, I'm reminded that this can be mean reverting, and so maybe we don't get used to that. It does seem as if a lot of the data has been softening out of the United States.
Absolutely, and I think we're getting closer to a turning point, this elusive turning point that's not been around for a while. But I still think that's a theme for a few months away. So I think the risks are growing for markets, but they're not getting closer in time. We are in that bad news is good news kind of regime for stocks at the moment. What is worrying is when, you kind of get to bad news is bad news, and then you get to this period where good news is even bad news. We're not close to that yet. So I think that overall, for the moment, even though the economy is slowing down, what people are saying is, okay, that's taking rate hikes off the table. But the fact is the consumer has kept spending until now. Earnings are still overall strong. That means the equity market will be supported for now. We're going to get to a harder dynamic, but I think we need to see clearer evidence that the US consumer is actually going off a cliff. We have some signs, but it's really hard to say it's happening just yet.
Walmart's going to be reporting numbers a little bit later on. The call is at 8 a.m. Eastern. I suspect that a lot of people are going to be tuning in for more evidence as to what is happening with the consumer from that call. Mark, stay with us. We need to bring in some more voices into this conversation. Bloomberg's FX and rates editor, Aileen Oyamada, joins us now on set. Nice to see you this morning. The data in totality is kind of telling us that maybe Goldilocks was right after all. Mark kind of says that actually both of these two data sets probably point us in that direction. What do you think? It struck me yesterday that the CPI data was more sort of equivocal, that you can read into the data maybe a little bit of sticky inflation still sort of with us. The retail sales story, though, was just right. It was kind of a slowing consumer but not falling off a cliff, to Mark's point.
Yeah, I think like Mark said, it was a modest improvement and not something that changes the game longer term. But to understand the market reaction, you have to look back at what we saw in the past months, which was like this huge repricing. And the market was, until recently, discussing whether we would see rate hikes. Then Powell put this off the table. And now this CPI kind of validated that, yes, you can bet on rate cuts. And the question now is when, and then we started to see people like really saying maybe July is a live meeting. So I think it brought back that hope that, yes, the Fed will cut rates this year. Yes, our bets on one or two are right. And that ignited a powerful rally.
Does July seem premature to you? I mean, how many more data sets do we need for them to validate? It does seem like Powell has a bias towards wanting to cut. Other members of the FOMC sounding more hawkish. What data do we need to see? How much time? How much conviction? How many more rounds of softer data do they need? And is July looking too early?
It may be too early because if you hear what they are saying, they really want confirmation that this slowdown in inflation trend is continuing. And the current pace that we are seeing, although it was lower than expected, the core, it is still not enough to generate inflation at 2% target. So you will want to see more data confirming that.
I really feel like I've seen this movie before this year 2 or 3 times, to be honest. Mark, aren't we once bitten, twice shy here? Why do we believe now?
Look, I think July is definitely too early. I think that, we're going to need to see a market downturn in the consumer for them to suddenly cut rates. I don't think they can get away with doing it now. But I think there's a really interesting point that you made there, Guy, about the sticky inflation print yesterday. And while in the short term, yesterday kind of keeps this Goldilocks scenario, the real risk is that we transition into a stagflationary fear and not just a slowdown fear.
And that's definitely the worst case scenario for the markets. So the worst case probably is kind of no landing, then a hard landing, maybe. But stagflation doesn't sound good. We're back to the 1970s. 1970s were good. Maybe not. Anyway, Aileen Oyamada, thank you very much indeed. Mark Cumble, thank you very much indeed. You want to get the latest from Mark's team, MLIV Go, on your Bloomberg terminal is where you will find that. Up next, we're going to talk geopolitical risk. There's plenty of that to talk about this morning. This is Bloomberg. Past the hour, welcome back. You're watching Markets Today. We're 30 minutes away from the start of trading here in Europe. We're very much focused as well this morning on what is happening with the geopolitical risk. You have the Xi-Putin meeting that is taking place right now. They're both in Beijing, and we are seeing live pictures coming to us from there. President Xi is currently speaking. I have to say, guys, there's not a lot of substance coming out of this, it appears, at this time, when these two are in the place of trying to mutually reinforce each other. The language doesn't sound as strong as maybe we would have anticipated.
Which, if you're sitting in Washington, D.C., of course, or in Brussels, may be a positive, given the pressure that's come through from both European capitals and the US on China, particularly in terms of the export of some of those dual-use capacity pieces of hardware and tech for the Russian military. And we know that's where the concern is, and the threat of additional sanctions on Chinese banks, which it seems some Chinese banks have taken pretty seriously. So a couple of lines crossing. They're going to have further cooperation in terms of the border, and there is an unresolved border dispute between the two countries, transport with Russia, and then signing some documents around Russian beef and new news cooperation, intriguingly. Yeah, there is some wider language also between the two. Well, this coming from the Chinese side, as Xi saying he's prepared to consolidate the friendship between the two peoples for generations to come. That their cooperation is one of the main stabilising factors in the international arena, and going on with further language like this. But in terms of, to your point, Guy, in terms of actual deliverables, and even the warmth of the language, perhaps, maybe there's something a little missing here. We'll see how this develops.
The language has been very strong in the past, so maybe our expectations are higher in terms of how strong the language will be when they meet again. And maybe this is more normal in terms of the kind of traditional diplomatic exchanges between these two, which have been growing stronger and stronger. Whatever happens, this is a cementing of that bifurcated world, with the ripple effects, of course, as a result of this. We keep across, of course, this state visit, a two-day state visit, of course, by the Russian Prime Minister Vladimir Putin to China. And we'll keep across that story for you. Meanwhile, Slovakia's Prime Minister Robert Fico remains in a serious condition after that assassination attempt yesterday. The country's interior minister says the shooting was politically motivated. Let's get more on this story then with Bloomberg's Andrea Dudek, who's across all of this for us, joining us out of Prague. Andrea, what do we know then at this point about the Prime Minister's latest condition?
We haven't actually had an update on his condition for hours now. The latest we heard was from one government official who said that Prime Minister Robert Fico may be out of life-threatening condition, but we really are waiting for confirmation of this improvement from a wider group of government members or the medical staff. Now we're told that there will be a news conference after the government meeting that starts in about 2.5 hours from now in the Slovak capital.
And what kind of... Talk to us more about the politician himself, so Robert Fico, and the role that he's played recently and in the past, because it's been a very long history in Slovakia for him politically.
He has now. He's now in the fourth government that he is chairing. He's one of the longest politicians serving in Europe. Over the last few years, though, he has turned into a populist leader and a fierce critic of European values. In the country itself, he has become the voice against everything from vaccines to immigrants. He's critical of the LGBTQI community, what he calls liberal media and non-governmental organizations. And on the political front, on the foreign policy front, he has refused to send more weapons to Ukraine, which has been a U-turn in Slovakia's foreign policy. You can see in many of his actions and ideas that he mirrors often his friend and a close ally, the Hungarian Prime Minister Viktor Orbán.
How politically divided is the country? This is an extreme event, but maybe it speaks to wider tensions. I'm sure it does speak to wider tensions. Talk me through how polarized the country feels right now.
The country has had a very complicated history ever since it became a country in 1993, but then it joined NATO and the EU in 2004, so things have improved. But it has not been as polarized as we have seen in the last few years. And what happened yesterday really split the nation. While all officials just were shocked and horrified by what happened, and they voiced their support for the prime minister and his family in these difficult times. There were voices coming from some of his allies that just showed how deep the divisions run. You know, some of his allies called for a war against liberal media and the opposition, and those kind of voices just show that the division is so present in the country.
Thank you very much, Andrea. Thank you for joining us. Bloomberg's Andrea Dudic in Prague. We thank you very much for joining us. On to other European politics and division, perhaps. Dutch election winner Geert Wilders says he has sealed a tentative agreement to form a coalition government. Wilders' far-right Freedom Party captured the most seats in the November election, but until now has been unable to form an administration. It's been a little while in the making. Let's get some analysis. We're joined by Chan Koch, who joins us from Bloomberg in Amsterdam. Chan, good to speak to you. So what are some of the takeaways from Wilders' coalition agreement? What do we know about the way that this might come together?
Well, the four Dutch parties led by Geert Wilders' far-right Freedom Party presented their coalition agreement early Thursday. And the main takeaway is that they want a crackdown on migration. They want to limit the inflow of asylum seekers. They want to reduce the number of international students. They want fewer expats. So some of the Netherlands' biggest companies like ASML would not like these policies because they heavily depend on foreign talent. Another interesting detail from the deal is that they want to cancel a 15% tax on share buybacks, which was reported by Bloomberg last week. This is probably the most business-friendly policy. But they also want to undo some of the environmental policies of the previous governments, such as the cap on nitrogen emissions. And some of these policies are also expected to draw criticism from the European Union.
OK, so maybe a bit of whiplash for business on the back of some of these changes around the investment side and the immigration. In terms of the cabinet, Chan, what do we know about the cabinet that's being assembled and who's likely to be the Prime Minister then?
Right. So Wilders and his coalition parties will get to tap the new prime minister, who's expected to be a lower profile leader than the heads of the four governing parties. They haven't announced their candidate or their cabinet members yet, but Ronald Plasterk, a former education and interior minister, and currently a conservative columnist for a Dutch newspaper, is seen as Wilders' most likely pick. He's a member of the Labour Party, which is in a part of the talks, but Plasterk has drifted away from his party over time. We're expecting an announcement of Prime Minister as soon as today.
OK. Chan Koch in Amsterdam, thank you very much indeed in terms of the political developments unfolding in the Netherlands and the context implications for the business world. Chan, thank you very much indeed. Going back to the pictures, we're getting live pictures still from Vladimir Putin and Xi Jinping, of course, the Chinese president, in Beijing. The Russian president, as you can see, speaking now, talking about the talks that have been unfolding between the two leaders, saying the priority in the talks with China were trade and investments. And we know that trade flows have boomed between the two sides into the hundreds of billions of dollars a year. Meanwhile, Xi Jinping saying that a political solution to what he describes as the Ukraine crisis is the right direction.
Can I just go back to the conversation about what's happening in Europe? The lines between... You've got Geert Wilders, a man who is basically under 24-hour security, heavy security, because they're worried about his life. You just had Fico being shot in Slovakia. Europe feels like it's in a much more fragile place this morning than it did a year ago, just politically. Even then, we were dealing with the Ukraine war. But it does seem as if the polarisation, the divisions that we're seeing in this region are being magnified. You've got what's happening with Le Pen in France. You look at what's happening with the AfD in Germany, which maybe is fading a little bit. But this polarisation, it's going to be really interesting to see how it does affect Europe as a place to do business. We were talking about ASML just a moment ago and the concerns around kind of what's happening with immigration. Yeah. Does this have a meaningful impact on Europe's ability to kind of step up a gear?
Yeah, it's interesting to think about how much flexibility there is around European ideals, I suppose, and the way that the European Commission sees Europe. Yeah. Is there flexibility around that? Certainly in the East, we're seeing the threads being pulled, and we're seeing certain international players willing to pull at those threads, the likes of Vladimir Putin and the Chinese leader when he was here, certainly picking off nations that they feel are friendly.
This is something
where Xi visited.
Moscow and Beijing have been rubbing their hands in glee at the fissures that you're seeing in Europe now, and they'll try and exploit those, both parties, and in unison in some respects as well. And then you've got the added unknown, of course, of the election in the US in November. And if you get a Trump presidency, how does that add to some of the fissures in Europe as well? So when we start talking about banking union and capital markets union, I mean, it does seem kind of pie in the sky when you think about the inability to cooperate on some of these most fundamental issues.
Well, I'm not sure anyone going to the ballot boxes thinks too much about banking union, but your point is right, that at a time when things appear to be fraying, the idea of more union is, it requires some political explanation.
I find it fascinating that she went to Hungary. I find it fascinating that kind of these divisions exist. And, it's going to be harder to get these deals done. And we've seen that with Viktor Orban time and time again. He just slows things down, makes things harder to do. There's more friction in the gears of Europe's ability to kind of move forward. We'll see whether that has a meaningful impact in its ability to kind of translate all of this into economic growth, higher economic growth. We're going to carry on the conversations around what is happening with the business world in just a moment. The CEO of EasyJet announcing this morning that he is going to be stepping down. Johan Lundgren will be joining us shortly. We'll talk to him about why. This is Bloomberg. 15 minutes to the start of equity trading here in Europe. One stock that we are going to be keeping a firm eye on this morning is EasyJet, out with numbers this morning. First half revenue, £3.27 billion, slightly ahead of estimates. And the first half headline pre-tax loss, £350 million. Again, slightly better than the anticipated number that we got from analysts. The big headline, though, this morning is that the company's long-standing CEO, Johan Lundgren, is going to step down in early 2025. He joins us now. Johan, good morning. I'm assuming you're not going to be putting your feet up, but give us the reasons why now is the right moment to hand over the reins.
Well, first of all, I'm not sure what I'm going to be doing after, after I leave as a CEO in here as well. But look, this is an orderly transition as well. I've been with the company now for 7 years. We've gone through a lot of, positive changes and transformation, and this has allowed the board to do a thorough search. And I'm so delighted that they chosen to appoint Kenton, who's, the current CFO of the company, as CEO. He'll be a great leader for this as well. But I'm immensely focused to deliver a great summer, and land the initiatives that we have ahead that's going to also deliver opportunities going forward. So there's still some time away.
OK, 2025, early 2025. We'll have another discussion then about what you're going to do next as maybe the plans begin to firm up. Let's talk about the summer. Michael O'Leary out the other day saying he sees maybe prices not being as high as he anticipated this summer. What are you seeing in terms of pricing this summer? What does visibility look like?
Well, first of all, I think it's fair to say that we haven't given any views on the exact what the pricing is going to be. There's still too much capacity left on the market. As an example, we have only sold 39% of the capacity that we have here in Q4, which is our July, August, and September. But what we are saying is that, look, we have a positive demand. We booked more than 1 million more passengers this summer than compared to this point in time last year. And we're seeing that yields are slightly up. If you're looking into the Q4, load factor is also ahead. And we expect also revenue per seat to be slightly up in the quarter that we are in. But it's still too early to determine actually what the fare environment will be. But it is a positive demand that we've seen from the previous summer continuing also into this year.
OK, Johan, good morning. Very nice to speak to you. Can I ask you a little bit about the EasyJet holidays business and the extent to which, how that's doing? Are you concerned about others, like the likes of Ryanair signing deals with travel agents coming into that business? And what does it tell us? You've had a background before you were at EasyJet more than 7 years ago, a background in package holidays. What does it tell us that the sector is embracing that kind of product once again?
Well, EasyJet Holidays is an absolute unique business model. It cannot really easily be that replicated because it builds upon the network that we have. And there's no other airline in Europe who flies from the primary airports more than we do to these beach and the leisure destinations. It also builds on the trust of the brand that people have with EasyJet as an airline. And also we have a great team there in place. And this is going to deliver over 170 million of profit for the company this year, and it had also a very, very strong winter behind it. So it's very, very unique. 7 to 8 out of 10 times when you book an EasyJet holidays, you're getting a 4- and a 5-star hotel cheaper than you can get anywhere else, and you're getting it also at one of the most connected airlines in terms of the frequencies. So you got flexibility, you got a very, very attractive pricing in there as well, and that is not easily replicated by anybody else. But it's a great success and hugely well done and executed by the team.
What does it tell us about the consumer, though, Johan, that they want that kind of packaging? Because years ago, the whole point of the low-cost airline sector was to unbundle everything and allow people to only pay for the things they really valued. And now we seem to be bundling back again.
Well, I'm going to reveal how old I am, but I remember one of the first meetings when I joined this industry. This was back in the end of the 80s. One of the first meetings I was part of was actually to say how we're going to save ourselves from the threat of the death of the package industry. Look, this form of travel provides extraordinarily attractive pricing because it really drives on value. But the difference is now compared to what this was previously and with our model is that you can use it in a flexible way. So your duration isn't longer just a 7 nights holidays or a 14 nights holiday. You can fly and decide to fly, in the morning or in the afternoon. You can stay for 3 nights. You can stay for 6 nights. And that flexibility is unique on what you can do with us together with the fact that we have large volumes, so we get really attractive deals from the hoteliers, and all that value is translated into the consumer. So it's a different type of package holiday compared to what you've seen previously. And like I said, we're exceptionally pleased with the performance about that.
Johan, on the aircraft issues, you don't face the same issues, of course, as some of your competitors when it comes to Boeing aircraft. You rely on Airbus, and you don't face the same kind of supply chain issues, arguably, given Pratt & Whitney is not something that affects EasyJet. To what extent does that give you ambition to carve out market share, then, from Wizz and Ryanair, given that they can't run some of these routes? What is the market share you can take from your competitors?
Well, I think if you're looking at this summer as an example, we are growing, among the fastest. If not, we're growing faster than anybody else with an 8% growth that we clearly can see is higher than our competitors on the network. So, and that is a result out of the fact that, we have getting the deliveries from Airbus on time. I think we're probably one of the only airlines here in Europe who got our scheduled deliveries on time, 16 of them coming in this year. So, we got a big growth this summer, 8%, and that builds upon the winter where we also had, increased capacities of about 12% as well. But we look at this from a route-to-route basis. This is very targeted growth. We know we want to increase our presence at the prime airport, but we also open up new bases, Birmingham, Alicante. Today we also announced we're investing in our 10th base here in the UK South End, and that is just all reflecting on the fact that we have these opportunities for growth because we do have the capacity.
What's the biggest risk at this point?
Well, I think it's usually the things that you actually you can't control. You can mitigate the risks you can't control to hopefully a large extent, but clearly there is uncertainty in the geopolitical environment that we're operating in, and that's something that the industry has to live with ourselves. But we see that there's a positive demand coming into the summer. Operational disruption is clearly an issue always in the summertime. We know that the airspace is congested and there's more capacity being in there. But I think also the whole of the industry is better prepared for now than it's been in previous years. So we're looking forward to take our customers on a great experience this summer.
Johan, if the Bank of England cuts rates, if the ECB cuts rates, will we see a pickup in consumer demand? Is there a direct relationship, do you think, at the moment between interest rates and the consumer and EasyJet?
It's not that big of a difference because, some of these things are whether the interest rates goes up and down, when it puts a squeeze on the financial households, it's offset a lot by the fact that people prioritize their discretionary income, very heavily now on travel and holidays. And we've seen that's been consistent since actually coming out of the pandemic. This is the number one thing that people want to do. I think that the one thing that is always important and that do play I think a more important part than interest and so on is more about jobs. If people are in jobs, they get certainties about the jobs and an income, then that is the thing that really matters. So and that continues to look okay going forward. But I think mostly it's about the fact that people really prioritize their holidays and the travel.
Johan, I'm sure you're planning a few holidays of your own, maybe in 2025, later in 2025. We look forward to catching up with you a few times before you step aside. Thanks for joining us this morning. We always appreciate it. Johan Lundgren, the CEO of EasyJet. We're a couple of minutes away from the start of trading. EasyJet's going to be one of the stocks we're watching this morning. What else are we watching? Joe Easton, over to you.
Morning, guys. We're watching Siemens today, which is getting a negative reaction as they report a drop in orders for automated factories in China and therefore downgrade their guidance for that business. Now, this is interesting because last week we actually saw a warning from a rival over in the US called Rockwell Automation. It sent Siemens shares lower. It has recovered since then, but it is a very similar warning from Siemens today. Worth noting that a couple of these spin-outs from Siemens have already reported, Siemens Energy and Health, and here's the energy business, the real outperformer, almost doubling year to date for that stock, but this is much more negative. Have just read a bit of a Citi take on this, however, and they say they did expect a drop in this business, so it might already be priced into the market. Most analysts do have buys on that one. Then we're looking at Eni, the Italian energy giant. We've got a stake sale by the Italian government. They're selling around 2% of the stock, and it is at a discount. It's only a small discount. It's priced just below 15 euros a piece. We can see there it is trading at 15.11. So they've sold 92 million shares of 1.7% discount. This is as Rome looks to offload around 20 billion euros in company stakes in order to reduce the country's massive debt load. So it is potentially in line with expectations. Then we got Watches of Switzerland. Moving over to fancy Rolex watches, this much more upbeat than they have been in the past. A bit of a rebound seen in the US and Europe, and also a retraction in supply, boosting luxury prices. Keep an eye on that one today.
OK, Joe, thanks so much. Our equities reporter Joe Easton. More from Joe in the next part of the programme. Of course, we'll certainly keep an eye on Siemens. A negative spillover from the Chinese weak economy story into European corporates. This is Bloomberg.
Welcome back to Markets Today. A few minutes, of course, to go until the start of cash equity trading this Thursday. Getting a lift, of course, from softer inflation, softer retail sales out of the US. Risk on across these markets. Though the European futures have faded a little bit in terms of the upside we've seen at the start.
You look at the fair value this morning, it's actually fairly flat.
Yeah.
So it looks like maybe that move post-CPI has already faded out of the European space. And it doesn't look like the S&P is going to continue to bounce aggressively either. So maybe kind of... profit-taking? Well, I think there's probably an element of that. Yeah. You've got a whole load of other risks that are coming onto the horizon now, haven't you? You've got Walmart out a little bit later on today. You've got a whole load of Fed speak that you need to digest as well. You've got Nvidia next week. Do you want to be kind of all guns blazing going into this story?
Yeah, and maybe it gives us a moment to reflect on some of the individual stock names. Joe Easton was taking us through some of the lines this morning. I would just draw attention to Roche. They have an obesity drug which is showing promising results in an early stage study, and there's been some suggestion we might see that one go a little higher at the open. Joe went through Siemens for us, but that's a really quite stunning story around Chinese factory weakness and a lack of demand to refresh those factories.
Because the expectation from some analysts watching that stock was that this would be the quarter where the China story starts to turn around. There have been some green shoots from some of their competitors had flagged, but that didn't come through for Siemens. And then there's the digital part of the business as well, which you know is really, really important for them. And that also didn't perform and didn't meet some of the expectations. So Siemens is called lower by maybe 3-4% today. We'll see, of course, in the next couple of seconds. But that is potentially going to be a weight on the DAX.
It's interesting as well. We've been talking about what's happening in Germany. The sense seems to also be that German industrials are investing abroad at the moment, not domestically, and that sort of story also ties up with maybe what we're seeing out of Siemens, that kind of narrative about China and how important it's ultimately going to be. Anyway, European equities are about to open post-CPI. What are we going to see first thing this morning? Maybe a more muted day this Thursday as we watch maybe other factors start to represent themselves. There's plenty of single stocks that we do need to be watching. So the FTSE 100 absolutely unchanged, kind of dipping in and out of positive and negative territory already this morning. We're going to be watching EasyJet, we're going to be watching Zurich. We've already spoken to the bosses of those two businesses as well. But Siemens is going to be interesting. It'll be interesting to see whether the technology story continues as well. So technology was the big winner coming out of yesterday. Big tech stocks, Nvidia was a name that obviously was front and centre too as well. Does that translate into the sector breakdown that we're seeing here in Europe?
And actually, I think we also saw real estate doing pretty well yesterday. That was part of the narrative here in Europe. Not so impressive, not so standout today. Pretty flat, actually, for that sector. Here, we've got basic resources doing pretty well, up 0.7% or so. So that's the upside, along with insurance. And we've talked to Zurich Insurance earlier on today. And autos and parts moving lower, as well as the numbers out of Zurich Insurance. We've got numbers out of Swiss Re, and I see that stock is really strong today. And I was wondering how this would go down with investors, because they beat on the net line, beat on on a number of metrics quite convincingly, but in terms of the guidance, that didn't seem to step up as much as the beats might suggest. So interesting that the stock is up by 1.8% this morning.
You talk about the miners. Iron ore just surging in the session today. Again, tied to what's happening, some optimism around maybe the real estate sector in China. We had that Bloomberg scoop around a proposal. It is still a proposal to spend potentially up to $1 trillion to buy up all those unsold homes and units. But iron ore getting a big lift, and that's tying into the basic resources story. We keep an eye, of course, on copper. That, again, is at 10,318, and the gains keep coming for copper. Brent, WTI, also high by around 0.6%. So in the energy sector as well, the focus is there.
There's a lot of ex-dividends in this morning.
Yes.
Just need to count 24, I'm told, including Tesco, Daimler Truck, BMW, GSK, Unilever, SAP, Shell and BP. So if you're an income investor, today's a fairly big day as well. So that's factoring in on the downside this morning. Ubisoft, though, is on the downside as well. That stock is as a result of what we're seeing in terms of the earnings. And that is in terms of what we're seeing in the percentage drop. That's the biggest drop we are seeing this morning on the downside, 9.26% to the downside. So some quite significant volatility in some of these single stocks.
Yeah, and talking about things moving lower, Eni is weaker. We heard a bit about this from Joe Easton as well. Italy selling a $1.5 billion stake in that energy business, and as a result, that stock is down by 3.4% or so. And we also have positive developments though at Roche. That share price is gaining. The promise of that obesity drug, and I think all you need to say is obesity drug, and certainly in the last 12 months,
ding.
Yeah, it seems to strike a few chords, and so that stock up by 4% this morning.
You either add AI or obesity to your stock ticker.
Yeah.
You're going to get left. Down 0.4% on 0.5% on Siemens now. So that trading is coming through now. So we're getting a print on Siemens after the miss when it comes to the earnings. And we talked about the lacklustre performance over in the Chinese part of that business, or at least the exposure to China. That stock currently down 0.7%. So not a major reaction to that. A little bit of downside coming through right now. Down 0.8 now on Siemens.
It's interesting that actually the story today feels less about the CPI story yesterday. The numbers came out at 1:30 UK time, so in some ways we have already factored this in. So this morning's trade maybe less to do with that narrative, and maybe we're looking forward and also digesting some of the earnings that we've seen already this morning. It was an important number, and we had some great coverage yesterday. This is what some of our guests had to say about the data we saw yesterday.
Inflation it's taking its sweet time coming down, but we still think it's a downward trend.
The big picture on a core basis is that the rate of inflation has come down a lot.
Really great set of data, I think, for the Fed, especially on the inflation front.
This, to me, is a chair who wants to cut. I think that, and you can easily see one, and I think if he has the opening, I think he'll do two. And I think data like this, if it persists, I think that'll give him that opening.
I don't think July, but I do think September is possible.
We need to see more weakening in the data, especially on shelter inflation, for the Fed to begin to gain confidence and get comfortable in terms of beginning to ease rates.
The truth is, I don't think that we're heading into a higher for longer environment. I think we're heading into a normal for longer environment.
Yes. A host of voices there on Bloomberg TV. Guests from JPMorgan, from PGIM, from BlackRock, reacting to the step down in US core inflation. Joining us now with her views, Shikha Gupta, investment committee member at Astra Asset Management, which specialises in alternative credit. Very nice to have you with us, Shikha. Let's get your response then to the data we had out yesterday, to the inflation data. It seems the market has gone back to pricing in Fed cuts, happy days, Goldilocks back in the building. What's your assessment of what difference this makes to the corporate landscape?
We see that the data has inched down from the peak, but I still don't see anything that would warrant a significant monetary action from where we stand. As we have already seen yesterday, if you compare pre-GFC world to what we see today, all the way from World War II to GFC, the long-term Fed fund rate has been around 5.7%, and we are at around 5.5%. I think there is, if I have to make a case, there is a better case for a rise than a cut. Would they cut? Would they rise? Probably not. Feeding that into corporate defaults, I think they will remain quite muted. Just like we have seen in 2023, it's not going to be a surprise this year that the cost of debt has gone up.
Okay.
Corporates have remained profitable and have attended to their debt maturities. So I expect it to stay quite muted.
Okay, it's interesting that the way that history has played out then, Shika, because when rate hikes started, a lot of people looked at the profile of European debt and said there'll be these walls coming, debt walls, and refinancing will be required at higher rates. That's going to be difficult. Why has that not been more difficult? Has it been because profitability has held up, or is it for other reasons?
Absolutely. And corporates who have been around for more than 15, 20 years have sustained higher rate environment. And we already see some credit dispersion, so I would not say there hasn't been casualties. But we also have to admit that there are better solutions out there now compared to just putting a higher debt coupon on debt. So, you know, private debt is one example for that, that you are able to find more structured solutions now than just having an outrageously high amount of debt coupon, which has really helped corporates to find their runway going into future.
You say you see more credit dispersion than massive corrections. Just unpack that view.
So the credit dispersion has already been underway. Most of the corporates have sustained the higher rate environment, be it like profitability, be it attending to their debt maturity. But there are some corporates whose operating model just cannot thrive the current rate environment. And they would probably will suffer.
Where do they sit, those corporates? Which sectors?
So we have already seen most of the defaults coming in, for instance, in US from telecom, for instance. In Europe, also like media, healthcare. So debt that was, or the growth that was fueled through a very, low interest rate environment, primarily through debt, those operating models will have to change, in my view.
Morning. We all wonder, we spend our time wondering what is going on behind the curtain inside private credit. You're painting a reasonably benign picture, basically kind of signaling that alternative financing sources allow companies to continue. Is that something that is storing up problems for the future, or is it just giving these companies time to be able to adjust their business models to be able to have a future? i.e., are we just kicking the can down the road, or are we changing the shape of the can?
I mean, to many people's surprise, no lender wants to foreclose on a borrower.
Yeah.
The first thing they want is to provide some sort of a runway and give them a chance to survive and adjust. And even though private debt or private credit has its own set of challenges, I do feel that they are very, very well monitored when it comes to, they have to be paying their coupon every month or every quarter, so there is a test. Most of the debt have covenants like a yearly LTV covenant, an ICR covenant like the interest coverage ratio covenant. So there is a lot more monitoring and room for monitoring any migration that would come in for lenders to come in to foreclose if they really want to. But it does provide a runway for them to, find a way to navigate.
Do you think investors at the moment are more focused on the kind of the yield they're getting rather than the credit risk they're running? At the moment, everybody seems to be focused on the duration side. We can lock in some duration, we can get better yields. You've already indicated what is happening in terms of the default cycle looking kind of fairly well managed at the moment. But do you think we are underplaying the credit side of the risk profile?
I mean, you're absolutely right. It's a great time for credit investors to lock in higher yields. Being a credit investor, CRE, for instance, you are able to generate equity-like returns for a very low LTV debt. So there is a good opportunity for that. But at the same time, I think, given the credit dispersion, investors have to be really careful in their underwriting as well. And they need to just capture where they feel the real value lies and where there is a real, credit robustness lies.
Shika, you talked about how, lenders don't want to foreclose, and the first thing they want to do is offer some kind of runway ahead for borrowers. And that might very well be the case. But you also make the point in your notes, and other guests have as well, that the last 15 years in terms of rate environment, they were an anomaly. And so we don't expect to go back to rates as low as they were post-GFC. And so we maybe linger here higher than previously for longer. Doesn't that at some point have to crystallise? What is the result of that?
So, for us to see more defaults, there is one basic thing missing, which is acceptance between both lenders and borrowers. So, of course, even if you look at credit and CRE, both lenders and borrowers have to accept that the pre-COVID valuations are not viable anymore. In CRE space, if you look at office, there are structural changes in terms of the actual demand. And of course, the rates have also moved. So both parties have to take some sort of a hit. And until that happens, we are likely to see more of this muted effect in terms of amend and extend than actual transactions hitting the market.
When does that reality hit?
That reality takes a long time. There is not an easy fix like we saw in retail 10 years ago, and we are still repositioning, and the changes are still underway. Office is going to be a very similar story. It will take a long time.
Shika, thank you very much. Thanks for joining us. Shika Gupta, Investment Committee member at Astra Asset Management. That's the story around credit this morning. Let's go to stocks.
Let's talk more about what we're seeing in single stocks. This is what the Core 6 looks like this morning. Some interesting things happening, I think, obviously, in the pharmaceutical space. It's interesting that Roche is having some positive stories surrounding what is happening. Its obesity drugs. Is there any impact on Novo Nordisk this morning? Not much, as you can see. That stock down by 0.4%. Interesting to see that the tech stock story, though, does continue on the upside. ASML posting some positive performances this morning, maybe ignoring the Dutch politics story and focusing instead on the positive performances we saw yesterday. Interesting that maybe is the narrative that continues here in Europe. Nestle a little softer. Schneider Electric, the AI play, to many, up by 0.3%. What else are we watching? There's some pretty big moves this morning. There's quite a lot of volatility in single stocks that we need to be paying attention to. Joe Easton's got all the details there.
So we've got lots of red on this first screen here, particularly over in Germany. We've got Siemens coming down around 2% this morning, perhaps not as much as it was on the Tradegate pre-market exchange. Earlier, they have reported this drop in their factory automation business in China, cutting the guidance, but that was already predicted by some analysts, taking the sting out of that. So down 2%. Deutsche Telekom, meanwhile, they are seeing an improvement in the domestic German market, but not as much as some people had hoped, and that one is slipping very slightly. But take a look at Ubisoft. It's one for the gamers. Assassin's Creed, Call of Duties, all those games getting absolutely slammed, down 13%. A massive miss on orders in the last quarter, according to their statement. I don't know too much about those games. I'm more FIFA, a bit of Grand Theft Auto, but Call of Duty, Ubisoft is getting hit on that one today. Then we've got Umicore. This is in the chem space. They are actually announcing a change in CEO, a bit of a surprise. Warning of weakness in EV, so electric vehicle batteries. That is where the weakness is in that one. That's over in Belgium as well, so that one coming down 8% today, a big decliner. And we've got some big movers in the UK as well. There's EasyJet you were discussing with the now outgoing CEO, but we are seeing some weakness in some of their bookings, though the travel business, as you were discussing, the holiday business, looked pretty strong. So that one actually falling almost 6%, a pretty big decliner there. BT going the other way, strong numbers, a strong dividend once again from them, so they're doing okay. And Watches of Switzerland rallying. This stock's had a really tough time given a slowdown in Rolex watches, particularly in the US. It is, of course, a big player in the US and the UK as well, but we're rebounding today, up around 10% almost. Sage Group, this is in software, it's accounting software. It fell about 20% at the open of trading in London today. We're trimming that to 5% at the moment down in London. Still one of the biggest decliners. Again, it's on orders. The backlog not looking as strong as they had hoped. Then we're going to move over to the deals as well. There's a couple to bring you. We discussed Eni earlier. That one falling 3%. A discounted share placing, more than €1 billion from the Italian state, and that one coming down with that price. And then Evonik, that's a share placing as well. Again, we're back in chemicals, a seller over on that one. And I've brought up IDS. The Royal Mail owner got that bid yesterday. It was at 370. We're only trading at 319, suggesting maybe the UK government might just block this deal, so people not getting excited. They don't think this will go through for now, but it has got a bid from the Czech billionaire, and that one is adding to the gains yesterday, but well off the 370 price for that one. Then we'll look at miners. A massive jump in the Chinese property stocks overnight. One of the indexes there was up 12% as the government looks to pump money and pump bonds into that market. So I brought up the miners to see what we're doing in terms of copper. They were up a lot pre-market. Copper was up 2%, but we're pretty much trimming some of those gains. There are, of course, single stock stories with Anglo-American in the spotlight in terms of M&A as well. Then I'll look at Roche. You mentioned earlier that obesity drug data. This is Roche's biggest gain in 3 years. So you can see how that stock really doesn't move too much. This was part of their deal for Carno Therapeutics. They bought it in the US last year. It's got promising obesity drugs. However, analysts at Vontobel warning that this might not actually come to the market until the end of this decade. So it's a long way to go. Novo Nordisk probably going to be the market leader for a while, but Roche is up almost 5% this morning.
Wow, end of this decade. Yeah, that's a long time horizon, isn't it, Joe? As they all look to add those obesity drugs. The argument that maybe this is a bit of fad seems to be fading, at least for these drug companies. Joe, thank you very much indeed with some of the big movers. EasyJet really tumbling right now, currently down a little over 7%. I wonder your views on whether or not this is a reaction to the CEO executive leadership change that we see, which was a surprise after 7 years at the helm. He's overseen, by the way, a stock that's fallen over 50% since he took over in the end of 2017? Or is this just a market that was primed for a slightly better results? They essentially matched the estimates.
It's always nice when you're a CEO when you announce that you're going to step down and the stock drops. So in some ways, probably Johan is not too displeased with this, but it is still a drop in the stock, so he probably is displeased. The line that really stood out for me from the interview was it's too early to determine fares this summer. Michael O'Leary the other day was talking about the fact that he was seeing 0 to 5% fare growth this summer. Yeah. The original expectation was we were going to see 5 to 10%. So that's quite a material change. Johan's not willing to call it yet, which I think is interesting as well. I think if he had more clarity, he probably would be able to. But there's a little bit of clouds there, I think, probably to clear.
Yeah, there's something interesting about that, isn't there? Because on the other hand, he did say things that sounded like quite a positive story, talking about the run rate of bookings around the summer, how much better they're doing this time than previous time. So all of these things sound quite positive, but for whatever reason, not with the confidence to give that guidance on pricing is interesting. But a lot, as you said, Guy, a lot of volatility around individual stocks today.
Absolutely, and it's a theme that continues. Yet at the aggregate level, maybe not so. Talking of volatility, if you want to talk about volatility, this next story takes you definitely to volatility. Roaring Kitty getting a little quiet over the last few hours. The meme stock rally fizzling a little bit yesterday. We gapped lower yesterday, as you can see on the stock, and then maybe climbed back as the rest of the session developed. Has the meme stock rally faded? GameStop shares taking a little bit of a tumble yesterday, but still on a two-day basis, they are higher. We'll talk about all of this next. Probably a few 13Fs to throw in there too. We'll do that next. This is Bloomberg.
This is Markets Today. We are 21 minutes into the European trading day. You're seeing modest gains across the European benchmark of a little under 0.1% after the gains that came through yesterday. Of course, investors continuing to digest a more benign inflationary picture and of the US. US futures, by the way, S&P E-minis looking to gains of just 0.1% after a fresh record yesterday. Now, the meme stock rally has faltered with a chunk of the $11 billion gains by GameStop and AMC Entertainment wiped out yesterday. The stocks more than doubled after the return of social media posts by Keith Gill, a.k.a. Roaring Kitty. For more on this, let's bring in Charlie Wells. Charlie, wow, what a week it's been then for the meme stock frenzy that has reared its head again since 2021. Flashbacks to 2021. What's been going on and why the sell-off yesterday?
I mean, look, this was supposed to be a huge week for meme stocks, and it was, but it was just relatively brief. At least it's looking like that so far. And I've been talking to a lot of people on Reddit. I've been talking to analysts, and one story that I found kind of interesting here was that maybe this was a sort of tech FOMO play. That there are people out there who didn't get in on the huge tech tech rally. They felt like they were missing out. They saw some momentum. And I think what's been interesting here with some of these meme stocks is some of that options activity had actually been picking up before Roaring Kitty sent out the tweet that really kind of kicked off a lot of this price action. So this could potentially be people trying to get in on something in this boom that we're seeing and playing that. But of course, it looks like it's dying out. And I think this could be an indication that where we are right now is so different from 2021. Wall Street has wised up, of course. They know when to get in, but they also know when to get out.
Can I just flag, over Monday, Tuesday, Wednesday, the stock's still up 126%. So we talk about it fading. It's still up by 126%. So there's some significant gains.
Fair point. But I think what has also been interesting is this idea of hodlers. So people who may have bought in, flashing way back to 2021. Some of these retail investors, they bought in kind of near that peak. I think that's the kind of story that you hear.
Do you think they're getting out?
Getting out, yeah. And so on some of these platforms, we've actually seen more selling activity from retail than buying. And so that could potentially be indicating that there's some people who've been in for a long time,
right,
and they're finally at the point where they're like, look, I'm just going to take
Here's my option to exit.
Is there some broader story around the consumer attached to this then, Charlie?
I think one narrative you could take from this, if you think about retail traders, you think about them as consumers, you know, sentiment for consumers has been pretty bad across the board, but then there's been this strange story where behavior has actually been good. We've seen a lot of spending continue.
People going to Taylor Swift concerts.
Just like me going this weekend, even though my sentiment's not great, but they're speculating, right? If you are a retail investor buying into AMC or GameStop, that is speculation. I think everyone, including these people, know that. But, you know, does that continue? I think that's the real question here. And the other big one is, was this retail or was this institutional?
Talking of institutional, 13F filings, hedge funds, some of their positioning. What are some of the key kind of themes that came out from that detail?
And it's still continuing to come out, because I think do we get more today?
Yeah, so these will be rolling in. Bloomberg has so far analyzed well over 1,000 of these 13F filings, and they really show kind of where the smart money has been playing. What has stood out, at least in the realm of hedge funds who've had to make these disclosures, is tech. Of course, we've seen a huge piling into NVIDIA, surprise, surprise there. But two big names, I think, indicated some interesting moves. One was Michael Burry, his Cyan Asset Management, actually kind of backing into Chinese tech, so JD.com, their largest holding, which we're seeing in these filings. But also a mystery that we've been talking about for a while now was Warren Buffett. And so what we have seen in previous filings was an accumulation of stakes in some kind of financial company. We finally got the name of that financial company in these 13Fs, and that's Chubb. That is an insurance company. It's one of the largest in the U.S. They operate in 54 countries. $6.7 billion stake in Chubb by Warren Buffett.
OK, Charlie Wells, thank you very much indeed on the meme stock frenzy that seems to have faded, at least for now, and some of the detail around 13F that continue to come out. You talked about NVIDIA. The earnings are out next week. The stock is up 90% year to date.
Yep. And it's rallied back recently, so it's come, it dipped and then has come strongly back. So, yeah, we're kind of, I think we closed for 946 yesterday. We're kind of at 52-week highs. I
wonder if there's a sort of viral phenomenon theme that links these. You know, we've got meme stocks, which are certainly a viral phenomenon. Taylor Swift, to some degree, a viral phenomenon, although very much exists in the real world. And NVIDIA capturing a lot of attention from individual investors as well.
Yeah, to what extent the retail investor play is there. 951 right now on NVIDIA in terms of that stock. And to what extent it is still the most important stock in the world, as Goldman Sachs said a few weeks ago.
22nd is the numbers here?
Yes.
OK.
We will come back with some politics for you, some European politics for you. We are, of course, monitoring what's going on in Slovakia. We've had updates about Robert Fico. He had 5 hours of surgery for multiple shot injuries. His condition in hospital, we'll get an update on that shortly. This is Bloomberg.
Welcome back. You're watching Markets Today. We are 30 minutes into the trading session. As you can see, we're seeing actually a fairly muted session developing, quite in stark contrast, you could argue, to what we saw yesterday in the United States, where actually we got a bit of a rip on the back of the CPI retail sales number. The market kind of firmly believing, Tom, that we were in Goldilocks territory.
Yes, the FTSE 100 being hit certainly by the downside that's coming through for EasyJet, so that's a drag on the FTSE 100 so far in the session. Basic Resources you thought might have been a lift, but no, it's the airlines that are causing the drag on the FTSE 100. Let's cross over right now, though, to Paris, where Francine is standing by at the JPMorgan annual Global Markets Conference in the French capital, Bloomberg's Francine Lacqua, of course, on the ground for us with a great guest. Morning, Fran.
Yeah, good morning, Tom. I'm really excited being here. The JPMorgan chief economist, Bruce Kasman, joining us. It's buzzy. We're here at the Global Markets Conference in Paris. Bruce, thank you for joining us. It is buzzy. It's almost as buzzy as the markets yesterday. After that U.S. data, was it too much? Do you find the markets frothy?
Well, I think markets are correctly responding to the environment that we're on a sustainable growth path for now, that while inflation is elevated, central banks are not going to fight you. And that, I think, is something that markets like. I do think, however, that we're not getting inflation down. We're probably not going to get as much easing from the Fed and other central banks that markets are pricing in here. And there's a risk that central banks looking at what markets are doing now might calibrate their rhetoric in a more sober fashion. So I think you want to buy sustainability, the expansion. You don't want to buy central banks to being quite as friendly as markets think they are right now.
But Bruce, how can we be so sure, actually, that the next move from the Fed is down and not up, given the inflation dynamics that, for the moment, are fine, but they're also not, extremely favorable to what the Fed needs to achieve?
Well, I think the biggest reason that you should look for the next move from the Fed to be down is because that's what the Fed is telling you. What they're telling you is that even if inflation stays elevated, as long as they have a comfort level that it's on a trajectory down, they're going to be willing to move. That's what the ECB is telling us. That's what the Riksbank told us. So I think that's a reasonable expectation. I think what's important about yesterday's number was not that it was so low. 0.29 unrounded core was not a low number on the month of April, but it's probably not enough to shake the Fed from that path. And I think that's the important message. Could we be shaken from that path? Yes. Is it likely we're going to be shaken from that path in the next 3-6 months? Probably not, and markets like that.
But Bruce, if you look at the U.S. economy, I mean, it's not at all what the European economy is doing, or even the UK and the Bank of England. It's like firing on all cylinders. So, do you see any stress points of actually an economy that's overheating?
So I think it's hard to call it in a traditional way overheating because we're unwinding the very elevated inflation. We are seeing labor markets move somewhat more in balance. The question is, are we getting enough shift in the environment to bring inflation all the way back down? And I think the answer to that is no. I think the Fed is going to show patience and might even ease somewhat. I think you're 100% right to identify the divergence between U.S. performance and European performance, which has been much weaker and probably justifies some rate cuts. But the Fed looks like it wants to calibrate what it perceives to be a restrictive stance as we're making somewhat more progress. I think that progress is going to be limited, and I think the Fed has got to be somewhat worried about how financial markets are adding fuel to the fire as we look forward from here.
They don't look very stressed on that point, actually. Do you think the Fed and central banks in general should pay more attention to what to what actually market exuberance does to the economy?
I actually think, to me, the most surprising element of Fed rhetoric in the last 6 months has been the willingness to think monetary conditions are going to weigh on the economy when it isn't spilling into financial conditions, which have been on a straight-up easing path. When will the Fed start to get more worried about that and start to change its tune? I would have thought that would have happened already. I think it's a significant risk here, but I can't feel confident that that's going to happen as we move to the June FOMC meeting.
I mean, do we care about the neutral rate, or is it just, it's actually almost impossible to call out?
Right. I think neutral rates are higher. How much higher they are, I kind of take the view that normal is as normal does, which is that you're going to read the data. I do think the U.S. economy is cooling as we're going through the first part of the year. I think you see it in the survey data. I think you're starting to see it in some of the activity readings. The U.S. economy grew 3% last year. It's going to probably grow closer to 2% this year. It's not weak, but it's not quite as exuberant. And I think, again, the issue here is we still have sticky inflation, and how much is the Fed willing to run with that and still ease? Right now, they're telling us, and I think they will at the June meeting, they're still on track for doing at least 1 or 2 eases in 2024.
But, Bruce, is it right that actually, markets and to some extent also central banks are ignoring geopolitics? I know it's not really playing out in economies, but we're kind of redrawing on supply chains, but actually trade agreements that could really change the way we do business in 12, 18 months.
So I think if we're looking at the horizon of a year, I don't think geopolitics is having much of an impact on what we're seeing in inflation or growth data. I do think there's some risks that there could be a more substantial event, but I think that's hard to use as a tool in terms of setting policy. I think there's obviously big implications of how geopolitical events, and including, of course, the U.S. election is going to play out over the next 2 or 3 years. But I think it's correct for central banks to stick it to their knitting right now, drive their policy decisions off of what they're seeing on growth, inflation, and I think on financial conditions. And it's in the financial conditions space where I think the Fed has some more reckoning to do with how it's been communicating with us.
Does the Trump administration actually change the U.S. economy in the next 12 months from when, if he gets in the White House?
I think the election matters. I think if we're going to have a divided Congress, which seems a reasonable expectation under either side, I think it will change U.S. policy regardless of whether Biden or Trump comes into power. I think what worries me about Trump, and certainly at our conference this morning, people were arguing for Trump being a risk-on trade. I'm less confident of that in a world in which I think the U.S. has been helped a lot by our interactions with the rest of the world in terms of immigration, in terms of trade. And Trump wants to change that. He wants to close that off. And I think that's a danger to the expansion. And we're not likely in a divided Congress world to get a fiscal easing, which is what we got in 2017 and 18 under the first Trump administration.
And immigration actually has been pretty pivotal in some of the productivity numbers, right, in the U.S. It's almost a direct impact.
It's had an impact which I think people have most clearly identified on the supply side, and particularly labor force growth. And that I think is genuine, but I also think it's been underappreciated how much it's probably had an impact on demand, on housing demand, on consumer demand, on government spending. And therefore, from the point of view of the Fed and the inflation outlook, you have a little bit easier labor markets as a result. You have somewhat firmer pricing power, and I think the impact on inflation is not as easy to identify.
Bruce, when you look at Bank of England, ECB, when you look at BOJ, I mean, that's certainly not dull. And China, what do you think is most interesting right now, more complex for investors to figure out?
Well, I think what is most interesting right now in the immediate sense is the fact that the Europeans are moving before the Fed, that they're moving with still elevated inflation, which is very unlike particularly ECB. And that they're making a call here, which I think is correct, actually, that the legacy of weak growth over the last year, which is not the environment the U.S. was facing, does warrant rate cuts. So that willingness to move in a still sticky inflation environment is very unlike ECB from the past. And that's the most interesting thing. I think perhaps what might be the most interesting thing over the next year is the BOJ, which has a significant amount of pressure coming from what we think is a weak yen, continued pressure on inflation, and what we're expecting to be is a substantial lift in Japanese growth if we're right that the rest of the world is doing well. And I think the market is underestimating what the pressure might realize in terms of BOJ action when viewed over a 12, 18-month horizon.
But Bruce, a market expectation is now ECB goes, probably Bank of England goes, and then it's the Fed. I mean, this gravitational pull towards the Fed, how difficult does it make the other central bank's job? And do they cut once and then stop? And this would be like any other cycle that we've seen.
So I think there's probably less gravitational force from the Fed coming from the dollar or from any direct transmission, except for, I think, the financial market condition channel. If global financial conditions are really doing well, if European financial conditions are doing well, central bankers might have to think somewhat twice about how much they ease and how much they diverge from the Fed. We don't think the macro fundamentals are going to warrant a big divergence between European central banks and the U.S. in an environment in which we have European growth picking up, growing over 1% this year. Not exciting growth, but clearly better growth. I would say you probably are on track over the next 6 to 12 months for ECB to maybe moving once more than the Fed. That's not a big enough divergence to start to get really dramatic about And of course, macro surprises can change that, but that'd be our call right now.
Bruce, I just got back from Doha, where we also had Ken Griffin, and he was really kind of scathing on debt in the U.S. And he says, look, at some point there's going to be an auction that's going to go terribly wrong, and it will wake everyone up. Do you worry about some kind of big auction credit event happening?
So I think we should understand first and foremost that we've built up a lot of public sector debt. We have not addressed our deficit problem yet, but we've bought ourselves a lot for it. The U.S. has outperformed the rest of the world substantially since the pandemic. We've generated over $40 trillion of household wealth. So from the point of view of a sustainability perspective, this is not really a serious problem. From the point of view of, are we going to show responsibility to unwind that fiscal support? I do think the arguments that if the markets start to see the political environment of the U.S. completely ignoring the adjustments that need to take place and not showing responsibility, I think there is some risk that markets start to price in more credit risk, higher interest rates. But I think we should focus on the political economy, and obviously what's going to matter there is how policy shifts after the election later this year.
Bruce, thank you so much for joining us today. That was, of course, Bruce Kasman. We'll have plenty more from JPMorgan throughout the day. Back to you in London, Guy.
You certainly will, Fran. Looking forward to the conversations a little bit later on. Thanks to Fran, thanks to Bruce for now. But Francine will be back at the JPMorgan Global Markets Conference that's taking place in Paris. The main event, of course, is going to be a conversation with the bank's CEO. He, of course, is Jamie Dimon. That conversation happening at 1:15 p.m. London time. Looking forward to seeing what Jamie's view of the world looks like, maybe from a European perspective. Bruce, I thought was really interesting there. My main takeaway was that he was talking about this idea that financial conditions have eased significantly, and the Fed's been responsible for that. It started in December. You've seen the effect of it. At some point, he thinks that actually the Fed's going to have to start paying attention to kind of what is happening with its effects on the economy and the easing of financial conditions and how that's affecting financial markets, which is then feeding back into the economy.
We're back into that circle, aren't we? How much the Fed's communication does the work of the Fed for it, so it doesn't actually have to deliver on those things very quickly, as you say. What stood out to me, actually, was the number of mentions we got of fiscal policy. And as we head into an election year in many parts, and we're in it, of course, in many parts of the world, but notably in the United States, his reference to political economy. These are not just economies now. These are very political economies, and taking note of that and the different policy trajectories or the similarities between them for the next president will be really interesting.
Really interesting on President Trump, a potential President Trump in November, and saying that he was pushing back against some of the views in the room there, that this was going to be a risk-on event if Trump wins in November, suggesting he's not going to have that fiscal room. He said, look, I'm not as concerned as Citadel, at least Griffin is, around the debt load in the US. But in terms of that fiscal space that a President Trump would have, it's not going to be there, and he's concerned about the relationships between the US and those open borders in terms of trade that might well be closed off.
It kind of depends who's in the room, though, doesn't it? Like, President Trump, in the past, has delivered quite significant tax cuts. I remember the night that he was elected, everybody finally kind of figured that out kind of a few hours in, and suddenly the markets took off. And basically the people in the room there are likely to benefit from the significant tax cuts if re-elected that he's already said that he will deliver. So maybe it's just risk on for them.
OK, and somebody who will be focusing very much on the US politics, and the result there will be China and no doubt Russia as well. Coming up, we'll talk about how this meeting of politics and economy plays out over in Asia. Vladimir Putin is in Beijing for talks with President Xi. We'll discuss what the state visit means for the US, for Europe and for the war, Russia's war in Ukraine. That is next. This is Bloomberg. This is Markets Today. We're 47 minutes into a European trading day that looks increasingly negative, actually. Although at overall level we seem to be flat, but the FTSE 100 down by 0.3%. We've got a lot of ex-divs going on, so maybe that's having a bit of an impact. The CAC 40 down by 0.3%. In terms of the sector breakdown, actually, we're kind of half and half, negative and positive. Let's pivot to some of the geopolitics that could be weighing on sentiment of late. Russia's Vladimir Putin is in Beijing for talks with President Xi as Russian forces press ahead with a new offensive in Ukraine. China's leader welcomed his Russian counterpart as he began a two-day state visit. Let's get analysis now with Bloomberg's Rebecca Chung-Wilkins in Hong Kong. Rebecca, tell us what we know then so far about this visit. We're showing pictures of it now. We were talking at the top of the programme about whether the exchange of words has been as friendly this time as it has been in the past. What do you take away so far?
Yeah, a very warm welcome. And we kicked off, with that classic state visit, welcoming Putin into the Great Hall of the People. And he's met a flurry of people, not least that sit down with President Xi Jinping, but also smaller and larger groups. And we're now sort of getting to the denouement of today, at least in the Asia Day. We have had a signing of a deal involving things like cars, potential news cooperation, and plenty of warm words about the types of cooperation that we're seeing. Putin very much suggesting that the stress and the emphasis of talks has been on trade and investment, although he did say that they are planning to discuss international issues later. And in terms of sort of the geopolitics, we haven't had an enormous amount of sort of direct colour on that. President Xi Jinping did say that he thinks, in his words, that the direction of what he calls Ukraine crisis is correct so far. So sort of affirmative in that sense.
Rebecca, there are tensions in this relationship. Yes, they've met a little over 40 times so far, the two presidents, but there are some undercurrents of tension, at least historically. What are those?
Yeah, absolutely. I think there's a real sort of distinction here between the relationship between Putin and Xi Jinping. They've celebrated birthdays together. They've met more than 40 times. President Xi Jinping, since coming to power, has met Putin more than any other single leader from any other country. But when it comes to China and Russia, there are these longer standing issues. So, for example, the concern and the threat, the worry that Russia might use nuclear weapons when it comes to the war in Ukraine, that has a sort of personal resonance with China that has previously said itself to be sort of the victim of Russia's nuclear blackmail in the past. They've had disputes over their sort of shared border, for example, and there is a bit of this sort of push and pull over the economic reliance. On the one hand, Russia needs China to continue buying its energy and so on. But on the other, China itself has somewhat dragged its feet on signing deals, for example, to do with Power of Siberia 2, which would provide sort of longer-term support to Russia in that context. And there is a bit of this feeling as well from China's side of not wanting to rely too heavily on one single country for things like its energy security and so on. So there is certainly these sort of other tensions, these push and pulls and limits that we have indeed seen to the so-called no-limits relationship since the outbreak of the war.
Rebecca, great update. Thank you very much indeed. Rebecca Chung-Wilkins joining us out of Hong Kong on the meeting that is taking place currently in Beijing. Let's give you another geography. I want to take you a piece of geography. I want to take you back to Doha. The Qatar Economic Forum is underway, third day. Let's listen in to EQT CEO Kristen Sinding, who is on stage in conversation with Bloomberg's Eric Schatzker.
To AI, they worry, not without reason, that all the value is going to accrue to the LLM developers, right? The OpenAIs, for example, or the real arms merchants, the NVIDIAs.
Yeah, you could argue that, and I think Google itself is concerned, right? Because if you use ChatGPT, you probably do, we do, I do all the time. That means I'm not using the search mechanism any longer, and that powers a huge part of their income, right? The whole advertising model, the interactivity, the cookies, all these kinds of things. So their business models are changing. So I think there's certainly shifts in business that are going to be impacted by this across many different types of companies and value chains. But if you look in the long term, you think the next generation now is introducing voice, video, interactivity at a scale which we've never seen before. Maybe the change that's coming is about the same as when we got the iPhone first. And of course, all the applications that are needed to handle that. And even we also invested another angle into this, which is tech services. So primarily Indian companies that are helping companies move into the cloud or move into AI, because almost every industry is impacted by AI. Very few people have the competence. So if we own the companies that have that competence to help them, there you go.
The reality, of course, is that EQT is a $250 billion firm, and you invest not just in AI, but in technology and other areas. Let's talk about technology as distinct from AI. How do you think about it, and where are you looking for opportunities?
Yes. So if you look away from AI, we're investing in a number of different areas across the firm. We're trying to find long-term secular themes in society. One of them is the digitalization of society. The other one is, let's call it sustainability, moving to new energies, for example, as fossil fuels over time run out, and the aging society. So the number of themes that we invest, demographics, so, and that goes into the healthcare space. That's a big part of our business. The other big part of our business is technology. And there we invest in software companies across all value chains, really. We invest in technology companies that are serving some of those sectors that I just mentioned, serving these the green space. Agri-tech is a big area, and then we have industrial technology companies, so robotics, automation. Humanoid robotics is a very exciting space. We own a company called 1X, which is one of the possible winners in the humanoid robots race. Time will tell. It's very early. So if you think about technology, it's an enormous space, actually. And what we try to do is try to find the mega trends, break that down into trends that we can invest behind, and invest from different angles into those trends.
Could you be a futurist for a moment and share with us what you think a humanoid robot is going to be doing for us 10 years from now?
I think you'll come into the Bloomberg office, and the humanoid robot will receive you in the reception, help you find your meeting rooms, serve you coffee, clean the offices when everybody's leaving, security, handling security, that kind of stuff. But also, if you break it down into another part of the world, like warehouses, for example, the robots can, of course, work 24/7. They don't get back pain or neck pain. They're strong.
OK, that is Bloomberg's Eric Schatzker alongside the EQT Group CEO and Managing Director, Christian Sinding, talking about the investments around AI and the broader tech space, of course. Let's get back to the earnings story. Siemens, a disappointment, at least the investor reaction, the stock market reaction to that, currently down 2%. It was a mixed picture in terms of the details that came through. Let's take a listen to the CEO, who was in conversation with Ollie Crook earlier.
If the argument is about overcapacities in the automotive industry, for example, there always have been overcapacities. So what's the level? Does it really impact too much? I didn't expect really that the Chinese market would really substantial flooding the American market with the EVs. I don't believe that this is such a strong demand there. Same for Europe. So therefore, I do not believe that this has huge impacts. But I mean, this tariff and counter tariffs is maybe not what we want to see in a market which is start to picking up in growth in general.
OK, the CEO of Siemens talking to Oliver Crook on the back of the earnings, the disappointment around the key digital industries division where they actually downgraded expectations. Other parts of the business looking a little bit more robust, but the China story and the exposure there is not helping things at this point.
Ubisoft is down really hard this morning. Sage Group under real pressure as well. EasyJet down by over 7%. It's we've already asked why we think EasyJet is as soft as it is this morning, but it's interesting to see what is happening here. But BT Group bouncing back quite strongly.
Exactly. On the other side, we have a BT Group share price that's up by 9.5%. Roche surging on that obesity drug news, up by 3.6%. And some of the insurers doing pretty well. We spoke to Zurich Insurance a little bit earlier on pricing sounding pretty robust. That is it for markets today. European stocks flat at the overall level. Some weakness in Paris and London, though. This is Bloomberg.